All right, everybody. Thank you so much and welcome back. This is a star-studded appearance today. I don't say that lightly. The gentleman that we have on Minds of Markets today. This is Bob Iaccino. Everybody, he is a macro strategist and energy expert. He's a well-known strategist with over literally 5,000 media appearances, all the networks, CNBC, Bloomberg, RFD, TV with our buddy Scott Bauer, and more. He's now a principal and CIO of a startup of a fund of funds, and he co-hosts the Futures Edge podcast and Trader's Edge live show. Now, are you going to admit to all that?
No, absolutely not. That's not something. It was funny. We were talking about doing this. I'm like, do you want a short bio? And then I sent you that monster. So the longer one is ridiculous.
Well, but it lends a lot to your credibility, and I don't say that lightly. And as I said at the intro here, there's people in this business that you want to hang out with, and there's people in this business that you just look at them and say, full of what. You're the real deal.
Like those are some really kind words, and that's a really flattering introduction. The funny thing about it, Scotty, is like, you and I, as you mentioned, we are actually really good friends. It's not BS. It's not an online friendship. It's actually when we see each other in Chicago, we'd actually have conversations and enjoy each other's company. The strange thing about it is like you don't get those sort of relationships anymore with these people, with everybody being remote. I'm not saying being remote is bad. I'm just saying you don't build the kind of relationship you and I have where you could actually say that with a straight face. Yeah. As opposed to just, kind of stroking my ego for social media here. It's kind of nice to hear.
There's no question. And even after you left the Shy to greener pastures down in sunny Florida, we still stayed pretty close. So let me ask you, because how did you get into business? Did you study for this? Because I know I didn't. I got into this business by a fluke, which a lot of people did. What about you?
That's the one thing I miss about this business more than anything is the opportunity for young people to get into it by a fluke.
Yep.
I actually, my family owned a restaurant supply company. It started out as an Italian bakery. I started working there when I was 14 years old in Elmwood Park, Illinois.
Notice the Iaccino with the vowel at the end there, guys.
Yeah. So, I was like making cannoli and putting buns in the plastic bags and, making deliveries and all that as soon as I had my license. And we ended up selling that. That's a longer story than we have time to go into. And I was out of work for the only 6 weeks of my life that I've ever been out of work was then. And I was, some 20, what was I at that point? 27, something like that. And I actually sat there and said, well, what am I going to do now? And a friend of mine worked at the CME Group. And he said, why don't you come down and hang out at the Mercantile Exchange with me? I thought we were going to the merchandise mart. I'd never heard of the Mercantile. I was a political science major in college because it interested me. And I knew I was going to the family business. So I didn't really care what I majored.
Yeah.
I had a minor in economics. Again, it interested me. So I get down to the trading floor and the very next day I asked him to sign me back on. I just went around and begged for a job and got one. So that's how it happened. And I feel sad for younger people. I get a lot of people, I'm sure you do too. They reach out to you through your trading rooms or through your business or on LinkedIn or something and say, hey, I'll do anything. I just want to get into the industry. And I'm like, sorry, man, I can't help you.
Exactly. And that is how, people from our generation and probably even up to, maybe early 2000s. Yeah. If you knew someone, that was your in. There was, there wasn't the formal interview process. There wasn't, upload my resume to Indeed.com or whatever it was. If you kind of knew someone, that's how you got in. That's how I got in. So
I had to interview. I had to interview with 3 people to get my first job. First 2 people asked me regular questions. The last guy said, I got one question. It's very important. What temperature's the oven got to be for rye bread? That's how serious the interview was.
That's awesome. And there is something to be said for that. But you know what? Listen, different generation, different times. We've all got to adapt. Things work differently. But I agree with you. It's that opportunity is long gone, unfortunately. So you said you were a political science major, which because you were going into the family business. However, some of that had to have paid off because what you do now right? That's kind of your sweet spot.
Yeah, it is. So
your role on a lot of the media and a lot of your interviews and a lot of what you write about, your pieces for CME and stuff is really how the markets intertwine with economics, how things are working in the world.
yeah, it's 100% it. I like to say that I look at policy as it applies to markets as opposed to politics, because politics is just toxic. It's just ugly and it's awful. But policy is policy. And a lot of the times the biggest enemies in the world, let's just say in the US, biggest enemies in the US have the same policies. And so that was sort of the tiny bit of my college that I took, other than obviously the minor in economics, but the tiny bit of my college education that I took to the work that I do now. As a matter of fact, I'm going to be on, I don't know when this airs, but I'll be on Fox Business News with Neil Cavuto tomorrow. And I suspect, because it's Fox, there'll be policy. And one of the things you mentioned, that I was an energy expert, that kind of happened by accident, simply because I was living across the hall from a guy who had a boutique oil company. And I was trading for myself, and I was doing risk management for a couple of firms on a consulting basis. And this guy said to me, "Do you want to come to our firm and do some geopolitical strategy?" Again, the political science angle. Yeah. I said, sure. I started going to his office in the West Loop, and I became sort of their geopolitical strategist. And then I ran their stock options hedge fund that was internal for about 6 months. So I ended up learning a lot more about crude oil than I ever thought I needed to know. And then I started doing media interviews, and I'd answer some of these questions on oil. Then they started calling me only for oil, which is fine with me.
Yeah, I am certainly not an expert. I do not have the background in commodities like you do. My entire background is pretty much equities. But you're right. Same thing with me, especially with one of the networks. They will only call me for commodities, even though I'm an equity guy, and that's fine. I mean, know enough to be dangerous, I guess.
Yeah.
But, you just really touched on something. We talked about the opportunity is long gone, people to get into this business like we got into it. I also think, though, the opportunity for young people in any business is not as open, is not as broad-based as what you and I had or still have, where you can get a topic and then go run with it. I think that the young generation, and this is not good or bad, it's just different. They're pigeonholed into what they're doing, and they don't really have, I don't think, the runway, the freedom to really go explore other things in whatever job they're in.
I totally agree. And there's a lot of policy that led to that, unfortunately. I mean, you could take it from fiscal policy of, again, this is not a political statement because I don't make those publicly. Spending, going back 4 and 5 administrations, the idea that the spending should come from the executive and be approved by the legislative, as opposed to the legislative branch controlling the purse strings, which is the way it was supposed to be. Congress, again, neither party, just Congress has abdicated most all of their responsibility. And a lot of this has resulted in inflation that traps a lot of young people. You see a lot of social media posts from people young, and they're sad for me to watch, honestly, where they say, I saw one guy a couple of days ago, I make triple the minimum wage and I can't afford to live.
Yeah.
Now, some of that is a little dramatic. I mean, he probably has 3 streaming services and probably orders DoorDash every day. But notwithstanding that, they don't have the opportunities that we have, and that makes me a little sad.
There's no question about that. I mean, I know you're one, you count your blessings, I count my blessings, and I don't feel badly about it, that I had that opportunity. I look at it as the opportunity was there. Not everybody took advantage of it. Some of us did. But yes, I agree with you. It is sad. I mean, even, I look at my own kids who, knock on wood, they're adults, they have great jobs, but I don't think they have the opportunities that we had. I really don't. And for that, it is sad.
Yeah, it is sad. And again, there's a lot of that is policy driven. So I would just say, I wouldn't give my opinion on that. I would just tell people to watch how they vote locally more than nationally. It's much more important.
Let's not get started on that here in Chicago, which is enjoy your time down in Florida.
Yeah, it's one of the main reasons I left. So
I know. How did you kind of not transfer in, but how did you get introduced to the world of media? Right? None of us that are in media now, and none of us set out to say, you know what, I'm going to be interviewed on Fox Business, I'm going to be interviewed on Yahoo, et cetera, et cetera. I know, again, I got into it as a fluke, a total fluke. Way back one day when I was trading down on the SIBO back in the early 2000s, actually it was just before the big financial meltdown. I was in the S&P 500 pit trading for Goldman Sachs, and I think it was CNBC was on the floor. I don't even remember who the interviewer was. And I happened to walk out of the pit for a second, and I got a tap on my shoulder and said, "Hey, can you give me some commentary on this?" And boom, next thing I know, here we go. How did you get into it?
So it's very similar to that. There was a first tranche of traders, and there were 5 of them. And I wasn't in the 5. But all 5 of them had senior positions at the CME Group on the board of directors, the head of institutional sales or head of trading or something at senior firms. We're talking Goldman Sachs, Morgan Stanley, Smith Barney, Drexel Burnham, those days, right? And one day when CNBC decided to expand the amount of traders they spoke to, they said, give us 25 guys who can form a sentence. That's the quote that I got from the guy I knew. And one of the guys I knew, his name was Jack, he came up to me and said, "Hey, Bobby, do you want to try this?" I went, "Sure." And they put me in a booth on the CME floor, and they peppered me with some questions, and I answered them. And about a week later, they said, "We'd like to put you in the rotation if you're willing to do it." I did my first CNBC spot with Mark Haynes, the late Mark Haynes, 1999. And I had my trading jacket on and a big Sylvester Stallone from Nighthawks hairdo, and it was fun. It was fun at the time, but it was a lot different then as well. Media was a lot different then.
Oh, yeah. Yeah. I mean, you were doing the interview back then, and you weren't thinking about buzzwords. You weren't thinking about getting clicks. You were, building up your own business. You were just talking like you were talking to another trader in the pit and giving him your opinion on something. No, I totally agree with you. What was that Jack guy? Did he have the last name that started with a B?
He did.
Okay. I think we have something else in common there for sure. But again, it's so interesting how we get into these things, and then we just take advantage of them, obviously. I want to touch on something. You wrote an article pretty recently for the CME. And it was about the role of gold in turbulent times. And I read it, and I get asked about this all the time because we actually have another business at Prosper, a gold company. So I get asked this all the time. Is it really a hedge? Is it really the go-to, risk off asset, if you will, when the you-know-what is about to hit the fan? What say you?
So if you're talking about gold as an inflation hedge, no, it's not. And the reason I say that is because I did some exhaustive research on this. Gold responds to inflation because gold is an asset. Okay. There are other assets that respond to inflation to the positive. Now we have to keep in mind that positive is relative, because if your house goes up 10% and inflation goes up 12, you lost money. We all know that equation, right? But when inflation rises, people forget that asset inflation is part of the inflation equation, and gold is an asset. So if you have inflation that is not being, that the Fed is not attempting to fend off with higher interest rates, then gold will rise with that inflation. The reason I say gold is not an inflation hedge is because if the Fed is fighting that inflation and the inflation persists, gold will struggle. Okay, so you still could have inflation rising and you may not have gold going higher. But with respect to the people who hawk Bitcoin because, and I don't mean that as a negative, I own Bitcoin, but who hawk Bitcoin because it's a limited resource, so is gold. I mean, there's a limit to the amount of gold that can be found in the earth because it's a natural element formed under specific geological conditions. And the original tranche of gold was formed in the core of a dying star and came down here because meteorites landed. Gold is finite as well, right? And it is the original money. So it's not quite an inflation hedge, but currently it is. And I believe we're reflating. I believe the economy is getting stronger and inflation has bottomed and is starting to turn up. And I own gold. I've owned it since November of 2022, full disclosure, and I'm not getting out of it at this point.
Thank you. That was actually something I did not know how it was formed. So that's awesome. But you look and there's obviously a lot of hype in the media when something gets hot, whether it's a meme stock, whether it's a commodity like gold, and there are times you don't know what to believe, even if you're really knowledgeable about the markets. There's a lot that's very difficult to understand, and your explanation there that it's really not the hedge against inflation. I bet if you polled 50 people and asked them, is gold a hedge against inflation, you'd have at least 48 that said yes.
I mean, structurally, look, if you're existing in a zero inflation environment or a 1% inflation environment growth that we had been in for basically a decade, right? And you say, well, I'm going to own gold in case inflation starts to rise during that short portion of it. Yes. If the Fed had never said that inflation was transitory and sort of fighting it immediately, we wouldn't be here with gold. And that's why I try to get people to understand. In the past, I've said you should have 5 to 10% of your portfolio in gold. I am not a financial advisor, but I think it should be higher than that now. I think it should be a lot higher and it should be physical. And the reason I say that is because that S word hitting the fan that you so carefully danced around, we haven't experienced that. So we don't really know, but I suspect gold being money for 5,000 years, it probably would hold value. More so than, if we were to have some sort of electromagnetic attack, how do you get your Bitcoin? It's great that you can carry your wallet to another country with all your wealth in it. But if there's no power, how do you transfer your Bitcoin to somebody else?
Great point.
Yeah. So I like them both.
No, that's a very, very valid point. Last thing I'm going to touch on with gold, you have all these central banks around the world that have bought record amounts of gold. They've been accumulating for the last 12, 18, 24 months. They got to be doing it for a reason. Yeah.
So you could look at it as one of two ways. Either they think they need some sort of physical backing at some point in the future, or it's de-dollarization, or both. China was in the lead in Q1. Q1 was another record, as you mentioned, record central bank buying, and China was in the lead in that. But there were also some other pretty big emerging countries, as well as emerging market central banks that bought gold. I think part of that is a loss of faith in the dollar as a stable asset. Now, people think the dollar is not going to be the world's reserve currency. I don't think your kids' kids will see that, but their kids might. I do think it will. It happened to the pound. It happened to the Spanish doubloon. It happens, right? But gold will still be gold at that point in time. Yeah. That's why, to me, it's a generational asset now.
Speaking of the dollar, because I get asked this all the time now, and like you said, there's a lot of naysayers. There's a lot of negativity out there that the dollar is no longer going to be the world's reserve currency. To me, the dollar is really holding up right now, not so much because of our policy here or because of the Fed, but because other currencies are so much weaker, because other economies are not doing as well as we are. I mean, obviously, look at the yen. I mean, that's the debacle of all debacles. Right. You've got the euro, you've got the pound. Switzerland, they just lowered rates there. So to me, when I get asked why is the dollar holding up at these ranges here, to me, it's more so because of weakness of other currencies and economies rather than the strength of the dollar.
Spot on. I mean, if you look at it, we have a Fed who just, by the way, recently eased a little bit by reducing the amount of balance sheet reduction, right? They didn't change rates. But the ECB is expected to cut rates in June. The Bank of England, I don't think they're doing it at their meeting tomorrow. They might, but they're also expected to cut rates in June. Fed's up in the air. And the really real thing that drives currencies in the short term is interest rate differentials, right? And those interest rate differentials are driven by economic strength or weakness. Our manufacturing PMIs are back in expansion. They're not gangbusters, but they're back in expansion territory. ECB, or I should say European Union, ticked up, ticked back down. UK never made it out of contraction territory. So our economy is stronger, period.
Right.
So our dollar is likely to be stronger.
Which also kind of brings it full circle back to what you were saying just a little bit ago, that inflation's not going away. We're ticking back up.
I believe we are.
Yeah. There's no
if
question.
You look at it from services inflation, depending on what you're looking at, services inflation is wages. I know you know this, Scott, but I'm talking to people now.
Yeah.
It's wages. Okay. And the only way wages go down is through firings and layoffs. We haven't seen them. You don't go to somebody that works for you and said, remember that raise I gave you 18 months ago? Things have kind of calmed down. So I'm going to take that raise away. They're not having it, especially in unionized shops. So you have that situation. So the only thing you get is layoffs and firings. And we haven't seen that en masse yet. So services inflation is running somewhere, depending on how you measure it, whether it's employment cost index, average hourly earnings, somewhere in the let's call it 3.5 to 4.2% range. So that's your services inflation. And goods inflation has bottomed. It's still negative, but it's bottomed. Yeah. It's not going lower anymore. My brother has a restaurant in the suburbs of Chicago, Restaurant Bakery, sent me a text this week. A 50-pound bag of cocoa, which is in everything chocolate. Those are his words. $107 for a 50-pound bag last month, $275 this month.
It's unreal, isn't it?
Yep.
And that's why, small businesses are just getting priced out of the market across, regardless of what sector it is.
It's brutal.
They don't have the staying power. They really don't. That's unfortunate, but you'll have to let me know the name of the restaurant. I'd love to swing by. So
I will. I'll definitely let you know.
Awesome. Let's talk about your book.
Yep.
Higher probability commodity trading.
Yep.
What does that mean? I mean, everybody wants odds, right? Everybody wants to get into a situation, wants to make a trade where they think the odds are in their favor. We all have our own strategies. We all have our own methodologies to say, yeah, I'm going to beat the book, right? Mm-hmm. The odds are in my favor. How do you explain that for, commodity trading without getting in depth here? You don't have to give away all the secret sauce. I want everybody to go out there and buy the book, which you can tell everybody where you can find it. But
well, essentially it's easy to find. But what the idea behind higher probability commodity trading is that you're looking at a situation where the only thing you can control is the risk you take. Everybody believes they have an edge, and we all know what the math is. Okay. If you're going to lose 90% of the time, as many buyers of naked options do, you better hope that your winner is something that provides a huge amount of alpha in order to make up for those 90%, right? What I try to get traders to understand is when you're looking at structure of a trade, especially if you're new to this, okay, you want things that have limited risk because you can always learn to hold things longer, to adjust profit targets, to use trailing stops, to maybe roll something into a better option. I know sometimes you guys do that where you're in an option spread for a long time, which are the ones I've seen from you are, I believe 9 out of 10, if not 10 out of 10, they're controlled risk trades. And then you roll it into something else sometimes because it's doing well, right? Yep. You end up with what we call a K ratio, which measures the amount of money you make per dollar you risk. And however you do it, you want that to be positive. And that puts you in the higher probability category at that point. In my trading, I risk, it's okay. My trading, I have an average hold time about 26 days, and I make about $1.47 for every dollar that I risk. Okay, so from that perspective, I don't want to give out the percentage because it makes me seem like
understood.
Well, whatever. Yeah, but
understood. But the key is, and this is what you alluded to this. The key is what I tell everybody as well is you have to know your risk. Yeah. You 100% as much as you think the probabilities are in your favor and that you have the holy grail strategy, you don't.
Yeah.
Okay. You really don't. So you have to know your risk. You have to know where that maximum pain point is, and then base the trade around that. Base that K that you were talking about, that reward to risk around that. So that's awesome. Everybody should read this, because if you're trading and you're taking shots like that, that's a problem. That's, in my opinion, that's a problem.
Well, I'm really happy to hear you say that, because one of the things I used to say, and this is probably a reason that we got along immediately back in the day and stayed friends as long as we have, is the responsibility. I used to tell traders when I actually had an education company for a while. And the first thing I told these guys, I want you to go out and buy a little handheld mirror and keep it on your trading desk. Because when something goes wrong, it's not because of the Fed. It's not because of the Bank of Japan. It's not because the earnings didn't go your way. It's the person in the mirror. And if you can't get to the point to understanding it, you should go to much smaller, much longer term trading, perhaps to buy an old mutual fund, or stop. Because you can only control so much. And if you don't control the things that you can, you're lost. The rest is out.
Yep. Not only lost, that's when the emotion starts coming in. Mm-hmm. And you start to move away from what you know is the right thing to do. And when you really take all probability that may have been in your favor and throw it out the window. So yes, there's no question. It would seem like common sense, Bob, that people would trade that way. It's actually astounding to me how many people don't understand that. And I would say, at least with our students, one of the best commentary we ever get is, boy, you taught me how to control my risk. Yeah. Not so much the upside reward, but you taught me how to control my risk, which is a game changer.
I want to tell people that do follow you and are members of your various rooms and courses, something you told me 10 years ago, you probably don't even remember. You told me that the best email you ever get is, "Thank you so much for what you've done. I don't need you anymore." Yeah, I remember you saying that that was one of the best things that you could ever hear, because you're like, okay, I've done my job now. Some of them end up coming back. But, I want people to understand that trading is a trade. Okay. It's, why would you have to go to law school for 2 to 3 years and pass the bar? Why, if you're going to be a plumber, would you have to go have an apprenticeship and then pass some licensing exams and then work under an experienced electrician or plumber for as long as you do? There is doctors have to do multiple years of law school, then residencies before they go into their own practice. Trading is very similar. People think, I'm going to learn strategy and I'm going to be a successful trader next year. You're probably not going to. So if you just take it slow, if you're serious about it, the best thing you could do to be a trader over the long term is to trade for a long time. Mm-hmm. And the best way you trade for a long time is by preserving that precious capital and protecting it in ways that we know you can.
No question. And a lot of new people want to get into this and they want that quick money. And, I'm so frank with them, as I know you are as well. And I'll tell them, well, if you were learning a foreign language, right, you were learning Japanese, Chinese, Russian, Italian, whatever it was, would you be able to master that in a day, a week, a month, a year even? Probably not. Probably not. So that's the analogy I always use. And I think that hits home with a lot of people. But
totally agree.
You're right. I think, one of the reasons that we have gotten along and always had mutual respect for one another is because our values and principles about trading, I'm not going to talk about things outside of trading life, but our principles, are really aligned with one another. And we do what we preach, right? Yeah. We don't preach something and then go off and do something else. So a lot of respect for that, for sure.
I appreciate that, bud. Feel the same way, man.
I really, really appreciate this, man. You are awesome. I know you're coming up to Chicago soon, so I am hoping we can meet up for beverage. Maybe we go to Series. Who knows?
That would be nice.
But I'll probably see you over at the CME. And so great to have you on, Bob. I really, really appreciate you. I really respect you. Very thankful that you're here.
Thanks, man. Right back at you. I don't think it's possible for me to have more respect for anybody. I could have just as much respect, but not more for somebody like you. And again, for people who watch this, Scotty's real. He's not, again, just to add on to what you said, part of the reason we got along is a disdain for those people that try to get your money and tell you that you can do this overnight.
Yeah.
So stick with Scotty. He's not going to steer you wrong.
Thank you, man. Really appreciate it.
Good to see you, bud.
You too. Take care.
The Minds of Markets podcast is an exploration, a deep dive into the minds of some of the best traders and investors in the market. Our goal is to help you, the listener, learn from some of the best out there to improve your knowledge and skill set as a trader or investor. The Minds of Markets podcast should be used for information and entertainment purposes only. The opinions expressed in this podcast are our opinions only, and none of the information contained in this podcast constitutes a recommendation that any particular security, portfolio of security, transaction, or investment strategy is suitable for any specific person. Trading is risky, and past performance is not a guarantee of future results.